Okay, so this is very quiet. That means I should get going, huh? Okay, thank you. Welcome, everybody. My name is Dion Filmer. I'm the director of the research department here at the World Bank. Can we just do a quick check to make sure that you can hear me online? Can somebody just unmute and just say we can hear you? Or maybe you can't unmute. Or can someone put in the chat that you can hear me? Oh, audio is good. Okay. So welcome to this edition of our Policy Research Talk series. This is a series where we in the research department organize to provide an opportunity to present work coming out of the department and share with colleagues both inside and outside the department, as well as external stakeholders beyond the World Bank. A warm welcome to those watching on WebEx and the live stream, and of course to all of you who've joined in person. The last 2 weeks have really underscored the importance of the finance agenda as it relates to climate. In this spirit, I'm really pleased that we can continue to contribute to this discussion on green finance. Today's session, I think, is particularly timely as we explore new research that can help policymakers and others design better regulatory mechanisms and financial instruments to reduce carbon emissions and promote sustainable investments. Our speaker today is Federica Zeni. She's an economist in the finance and private sector development team in the Development Research Group. Federica's research focuses on corporate finance, sustainable finance, and financial economics. Prior to joining the bank, she worked as a researcher at the Bank of Italy and as a quantitative analyst at British Petroleum. Enough said. She holds a BA and an MA in mathematical engineering from the University of Rome Tor Vergata and Politecnico di Milano in Italy, an MA in quantitative finance from the University Pierre-Marie Curie in France, and a PhD in finance from Imperial College, London. I'm also very pleased to welcome our discussant, just back from COP, Olivier Mahoul. He's the Global Manager for Climate Finance Mobilization here at the bank. Prior to this current role, that's in the planet vertical. Prior to this current role, he was practice manager of the Crisis and Disaster Risk Finance Unit in Prosperity, right? In the Prosperity vertical, where he led the Disaster Risk Financing and Insurance Program, which is a joint program between the World Bank and the Global Facility for Disaster Reduction and Recovery, and which is also supported by a number of partners, developing partners, donor partners. Since joining the bank in 2003, Olivier has been involved in developing disaster risk financing and insurance solutions in more than 40 countries. He holds a PhD in economics from Toulouse School of Economics and postdoctorates from Wharton Business School and University of California, Berkeley. Federica will start by presenting for approximately 40-45 minutes, after which we'll hear from Olivier for 10 minutes or so. We'll then open the floor for questions and Q&A from the audience. If you're watching online and you have a question, please use the raised hand option in WebEx or signal to me in the chat that you have a question, and I will call on you for you to ask a question. And we are recording, so just so you know, and also just please mute if you're not speaking online. With that, over to you, Federica.
Okay, thank you for participating both in person and virtually. As Dion said, my name is Federica Zeni. I'm part of the finance and private sector development team of the Development Research Group, DECAFP, going forward. So we all know that the Paris Agreement goal was to reach net zero by 2050 in order to avoid catastrophic consequences of climate change. Yet, as we are seeing from the map, we are having troubles are doing so. So ideally, we should we have to raise the cost of pollution homogeneously across countries. We could do so throughout a variety of instruments, such as carbon taxes or carbon markets, such as the emission trading scheme in Europe. Yet, the current regulatory framework is highly fragmented and overall insufficient. The reasons are that there's a lot to do with political constraints, but within economies and across economies, within economies, as I will discuss more in a paper, regulators and politicians may have a hard time in passing unpopular policies such as carbon taxes, but also there are equity considerations across countries because although in principle we should raise the cost of pollution homogeneously, we didn't contribute to create this problem equally in the first place. And so, as Dion said, there has been a lot of talk about climate financing, which in few words means the alternative of raising the cost of polluting is making it cheaper for firms to decarbonize. And the idea is that developed countries, which bear the historical responsibility and also have the resources to do so, should try to provide this climate financing needs, both for themselves and also for emerging and developing countries. Also, there's a paper that didn't come up of the Development Research Group, but it is still worth mentioning, a recent paper that shows that is also economically efficient to do so for developed countries. That we are, as you, I'm sure you all know, there have been a lot of talks at the COP, and instead of the $1.3 trillion of annual contribute from developed to developing and emerging market countries, we agreed to about 300 billions. Now, the point is that the goal is to reach that extra trillion through private sectors and also multilateral development banks. And so banks such as the World Bank are becoming the key players at mobilizing, at looking at inefficiencies and trying to solve them in order to make it for the private sector attractive to invest and to transfer resources across countries and to invest in the developing and emerging countries' decarbonization goals. So clearly resources are limited, and so it is important also from a research point of view to sort of like trying to understand more of everything in this context and specifically about regulation and the financial market side. So here in DECFP, I'm presenting some papers that have been developing throughout the last few years, but I have to say that there is also a lot of great work that has been done by other colleagues in other departments, and so you can always go on our website and check them. So I'm going to present 4 papers that are divided into 2 main sections. There are 2 theoretical papers that I contributed myself with other colleagues from academia, and 2 empirical papers from 2 colleagues that are present here. So from a theory point of view, we first are going to look at the interaction between a regulatory tool for carbon mitigation, which is a carbon tax, and green finance, or specifically a carbon finance. And we are going to look at this within an economy, within a single economy. Then the second paper makes the ambitious question on how we should structure debt securities so as to finance decarbonization goals in presence of manipulation or greenwashing. The second set of papers are, on the other hand, advancing our understanding on banks' reaction to climate policies. Again, both within a country and globally, so across countries. So let me jump to the first paper. There's a lot of material, so I've tried to make it attractive throughout the presentation. There's just a little bit of equation, I have to say, but they're going to disappear very soon, I promise. Okay, so as I said, here we put in comparison regulatory and financial markets tool for reducing carbon. You can see that on the left-hand side, you have the carbon price implied by the current regulatory framework. On the right-hand side, you have these so-called sustainable debt securities as a percentage of total debt issuance across countries. And so you can already see that the green finance is, at least on paper, more geographically widespread. There are countries that have both, countries that have just the green finance, countries that have just the carbon regulation. So what we want to understand is within a single economy, what happens if we introduce financial markets in a politically constrained country. So here there's a binary model just to let you understand the mechanics of the paper. Assume the economy is just made of two technology, a brown one and a green one. The brown technology deliver output for a certain investment. I deliver output and emissions with this pi is a production parameter just to justify the investment. And then there's a green technology, which for the same amount of investment deliver yet less output and zero emission. So there's a basic sort of like productivity gap, like a trade-off between investing in green versus brown. And then there are two types of agents in the economy, the so-called standard or self-interest agents, which only care about consumption, and they form a portion T of the population. And then there is another share of the population, which we call environmental or green. These agents care about their consumption, but also they experience this utility from the emissions that derive from their own actions. So this is similar if you think about to the sort of like to the preference parameter that we all might have. Like we don't feel very good if we know that we are contributing to the global warming problem throughout some of our choices. And so in this binary model, the preference parameter is actually pretty high. So it has to be higher than the productivity gap for some tension to be created. So then there's a regulator that cares about maximizing the consumption of both the agents and also internalize the right cost of polluting, which is this lambda. That is the social cost of carbon. Now, you can see that in an economy that is not regulated, the standard agent are going to invest in the brown technology and the green agent in the green technology. There's going to be a certain amount of emissions produced and a corresponding welfare. If the regulator set up a carbon tax that is at least as high as the productivity gap, then basically can reform the brown agent actions. So it give the right incentive to the brown agent to switch and to reform its behavior. So emissions are zero and welfare is actually higher than the laissez-faire if this lambda is high enough, which we argue to be in this case at the moment. And so the regulator should put up the tax. However, we have seen that the majority of the population is made of standard voters. And so in this very simple model where you need the majority is a bank solution, the tax either passes or it doesn't, simply it cannot enforce the tax. Now, the point is that there is a minority of the population which may be wealthy enough that is worse off in this equilibrium without the tax. And so the idea is that if we allow the green and the brown agents to trade among themselves throughout securities that depend on the emissions that are produced by the agent actions, we could in principle circumvent the political problem and achieve the same result as the carbon tax. It's important here to sort of like to give some, in practical terms, this security here as a debt component, like as a principal D, and then a payoff that depends on the emissions that the issuer produces vis-a-vis a certain benchmark. And this benchmark should be the emissions produced in absence of this security. And so the idea is that you can see easily as in this market, the green agent is going to act as a borrower, sort of like lend money and be prepared to pay for reforming the brown agent actions. And so basically we have this result that in absence of the carbon tax, there is this market for carbon contingent financing can arise, and basically trading is mutually beneficial. The green agent derive their utility from reforming others, the brown agent monetize their green preferences. And we at least partially solve this political problem. Now, the point is that still within the single economy, is the introduction of this financial market always welfare improving? In order to respond to that, we need to slightly make the model slightly more complex and specifically look at intensive margin interaction between the tax and the market for carbon finance and think about how these interactions shape the voter preferences. So now I have this simple graph that we have in this extended model that shows, so on the x-axis you see a carbon tax proposed in the economy, and on the y-axis you see the carbon market price that arises in the economy given the tax. And we basically show that the higher is the level of regulation in the economy, the lower is the price of the carbon market. And the idea is that it is increasingly costly to finance that additionality, so the extra amount of emission reduction. There's less demand for it, like a larger share of the population is actually happy with the tax and with the way that the economy it is. And so the sort of like there's basically less demand for these markets. Now, from the point of view of the voter, especially if the voter is self-interest, if it's a standard type, what happens is that the voter may internalize the fact that with a higher tax, financial markets are going to be less rewarding for their actions. And so the idea is that he's even less willing to support the carbon tax because he knows that in absence of the carbon tax, financial markets are going to come up and sort of like try to solve the situation, and they may make some profit out of it. And so the point is that the support for the carbon tax may be reduced. This we are talking about a single economy. So in practice, what is the ultimate effect of financial market is a quantitative question. Here you have welfare of the economy as a function of the tax. Ideally, you'd like to set up, in this case, a $65 carbon tax, yet in practice, you can only set up a $20 carbon tax. With the presence of financial markets, you get two effects. On one hand, you are basically on this green line. So on one hand, you shift on the left the welfare function, so meaning that you can get to the same level of optimal welfare with a lower tax. So you make it easier for the regulators to decarbonize, because part of the solution is provided by financial markets. But on the other hand, they decrease support for the tax. And so in practice, we are here at this point here. And so whether or not we are better off than in the constrained economy without financial markets depends on a variety of factors, such as the endowments of green agents, the endowments of brown agents, how preferences are strong, and so on and so forth. And so it is not always true that financial markets improve, make things better. It depends on the amount of political constraint that we have at the beginning and on the preferences in the economy and the endowments. Okay, so this is the first paper. Now let me move quickly to the second one. So we talked about financial markets, where they're good, when they're not. Now we go more into the details on how these debt securities should be designed. So one important thing that the previous paper missed is the fact that these emissions outcomes are not always measurable. And so the idea is that, can we really set up a financing mechanism such as the carbon contingent security that I showed before, or do we need to do something more? So the sustainable debt market has emerged about 10 years ago. It has tried to respond to this challenge already throughout the issuance of a variety of debt securities. In particular, it has differentiated into two broad categories. One are the green, they call it use of proceeds bonds. Those are otherwise equivalent to conventional bonds and loans, but they constrain the issuer to invest in predetermined projects that needs to be green or sustainable. And this is the green category. The second category, the red one, are the outcome-linked, so-called sustainability-linked bonds and loans. So those are general debt contract that don't constrain the issuer choices ex ante, but then they depend ex post on the sustainable performance. So they look more like the security that I showed before. However, we don't see that this red security are cannibalizing the green one, but rather we see the coexistence. And so we want to understand basically what's driving this, and more importantly, what is the optimal design, at least theoretically. So just to give you a bit more background on this, so there's a green bond. It's a part of the use of proceed structure. As you see at issuance, there's a selection of a project that is a wind farm in Belgium. This is issued by EDF in 2016. As you see, the bond coupon is flat, but at maturity, the proceeds are put in a dedicated account that can be verified by the investors. And so the investors verify that the proceeds have been allocated to construct wind farms. On the other hand, the outcome-linked structures such as SLBs, so this is issued by Enel in 2021 for the general objective of reducing direct emissions. And so these are general purpose bonds, but the bond coupon varies with the emission reduction performance of the issuer. And so at maturity, there's not the reporting of how the proceeds have been allocated to, but rather a reporting of the final emission reduction that comes from this financing choice. Now, the paper basically makes this theoretical question of how we should optimally finance the decarbonization goal of a firm. So the idea is that there's a green investor, an investor that has sufficiently clear preferences that makes a monetary transfer to the firm in exchange for this green outcome, such as the reduction in carbon emission. Now, a key feature of the model is that this green outcome, if you sort of zoom into it, it can be is the outcome of multiple actions. It can be both delivered by installing green technologies, and this is more what we call extensive margin choices, like you either install it or not, but also by exerting effort to become more environmentally friendly, or generally to reduce your consumption of energy, even without changing technology. And so those are what we call intensive margin choices. We also argue that the quality of the technologies, those are sort of like uncertain investment ex ante, and you basically know their quality later on after the financing choice. And overall, the firm can manipulate basically both the outcomes that comes from these actions, because we don't have yet a great technology to measure, a great ability to measure these carbon emissions, or at least our ability vary a lot across industries, and for some industries is actually very bad. So this is the paper is basically just this slide. What we call the contractible dimensions are two. So as investors, we observe this imperfect outcome that we know has been partly manipulated, but we can do one thing. So it's easy to verify for us if the green technology is installed or not. And so the paper, the main proposition of the paper is that in presence of this manipulation risk, we cannot just have a security that depends on carbon emissions only, but rather we need to have a security that uses but this contractible dimension. So we want a payoff, an interest rate on the debt, if you want, that both depends on the performance, on the green performance of the issuer throughout this beta variable here, red, but also a reward specific to the project, to the technology installation. And so this is more similar to the use of proceeds structure, where you basically have an interest rate discount at ex ante if you implement a certain project. And so the optimal contract should blend the two categories that we see in the market. And an important thing also is that the optimal contract should be flexible ex ante. So in practical terms, I should pay you both for your green performance, but also I should have a certain reward if I verify that you have implemented green technology. And so the firm should report quite a lot to the investor, but his use of proceed choices, but also his green performance. And you can see that depending on the level of manipulation, these two dimensions are more or less important. When we can observe very well outcomes, then we can only rely on sustainability-linked bonds. When we cannot observe at all, then we go back to the green bonds, which were the initial structure. Now, the interesting thing is that even though I don't think that anybody looked at my paper, but World Bank issued recently a bond that blends the use of proceeds structure and the outcome linked structure. And so I think that there is at least the potential, those are called sort of like super green structures and are receiving a lot of attention. So although, I mean, one may argue that there are like other costs like liquidity concern, transaction costs related with issuing such complex securities, at least it seems that we are moving in the right direction. And we see this example both from the private sector and from developing banks. So in practice, just to conclude, this leaves us with the acknowledgement that the current structure has some flaws, both of them. And what the paper shows, without going into details, and that you may overinvest in green technology with green bonds, so you enter too early in the green technology, and you may learn ex post that it wasn't the best choice. On the other hand, with sustainability-linked bonds, if the variation of the interest rate is very low, you don't have enough financial incentive to actually invest in a green technology. Green bonds arguably incentivize the technology installation, but not really any other effort beyond that technology installation. But on the other hand, we can argue that sustainability-linked bonds, although they incentivize effort, they may also be more manipulated. And so in practice, we show that the way industry prefer this security sort of like respond to these main factors. Okay, so this basically concludes the theory part. I'm now moving to the empirical part of the presentation, and this is basically joint work by Claudia and Alvaro, which are here present. So we have seen a bit of theory. We want to understand now a bit more about how climate policies affect banks' lending choices. And looking at banks is particularly important, especially because in emerging and developing countries, most of the financing, external financing, comes from banks. And so what the authors, so the first paper is a paper that looks at how climate policies affect basically banks' lending behavior in a global context. So we know that climate policies are good at promoting renewable energies, and so like make it cheaper to decarbonize, but also make it more costly to pollute, and that's overall good. But we want to understand how banks, which are not the direct, even though they are not directly regulated by these policies, how banks react, basically how banks' lending choices change when the level of climate policy change in the country. And here, the interesting part is related to potential leakage effects, because as we know, we are back basically to the map that I showed before. The carbon regulation is highly fragmented, and so an interest. It is important to see whether raising the level of climate policy in a certain country may basically enact some regulatory arbitrage, move a capital away from that country and towards countries that are less regulated. And this is specifically the case for banks that are very large and global and operates across multiple countries. And so the main question that they ask is like, how do global banks respond to changes in the climate policy of a country in which they have a subsidiary? So to do so, the authors try to divide the pool of global banks into two classes, the so-called brown and green banks. So we can see here that they identify the green banks as the first signatory to the Task Force for Related Financial Disclosure, which is an organization that promotes financial disclosure. And so the banks that were the first signatories, you can see that they have a much higher environmental score related to the one that sign up basically later. And so they not only look at how lending choices respond to the changing policy in the host country, but they want to look at whether there are cross-sectional differences. And it turns out that looking at cross-sectional differences is it's sort of like the important exercise, because although overall raising the level of climate policy in a country doesn't change much credit, the amount of credit that goes in or out of the country, you can see that there is quite a bit of mobility in the cross-section. And specifically, there's a selection effect where green banks attract more capital, so more capital goes to subsidiaries of these green host countries, whereas brown banks tends to move the capital away from the country. And that's the first paper. The second paper, it's only look at the effect within a single economy of prudential regulation. So a prudential regulation, so this is a regulation that forces banks to disclose their exposure to social and environmental risk throughout their lending choices. And here we go back to the theoretical structure of the to the fact that in principle, in order to decarbonize efficiently, you should ideally provide credit to those sectors and those firms that are highly emission intensive but want to decarbonize, right? And so what the authors warn about this with this prudential policy, which on one hand has the good thing of clearly how to say, limiting, ensuring financial stability in that country. The other warns about potential counteractive effect of this policy to the extent that they basically they incentivize the banks to just provide more credit to firms that are already green, so to firms that don't want to decarbonize, and to move credit away from firms that are brown and wanted to decarbonize. And so the idea is that here we really have to look at potential negative unintended consequences of prudential regulation in a certain country. So the others have an identification strategy because they only a certain amount of the exercise in Brazil, and only a certain amount of banks, the large one, are actually fully subject to the regulation. And so basically the others are able to disentangle the effect of the policy, looking at the differences across regulated and unregulated banks before and after the enactment of the regulation. And again, we have that in aggregate, there hasn't been much change in lending in the country as a response to this prudential regulation. However, in the cross-section, there are a lot of things happening, and specifically the large firms that were regulated are shifting credit away from exposed sectors, so from brown sectors. And this credit contraction has been partially offset by small banks that start to provide credit to firms. But we are seeing that the small firms operating in brown sectors are actually hit the most by this regulation, because there's not like a perfect substitution. They get basically worse quality of credit, or they actually experience a credit contraction. And so the response is that maybe in real terms, although others don't find like a large effect, the risk here is that small firms that wanted to decarbonize are going to be impacted by this prudential regulation. Okay, so to summarize the findings of our research in the KFP, well, we first show that in principle, carbon contingent finance can substitute for a carbon tax. However, we need to be aware of potential counteractive effect in the economy from the political point of view. Also, we show that in presence of greenwashing, there has to be fairly, like quite a big amount of structure, of financial structuring, in order for preserve additionality, but also eliminate greenwashing risk. And finally, on the empirical side, we have seen that like a lot of credit redistribution in response to climate policies, although in equilibrium the aggregate effect is limited. Perhaps the important message from this empirical work is that regulation to banks should try to be as least fragmented as possible to sort of like avoid this equilibrium readjustment. Okay, and with this, I'm going to conclude. Thank you.
Thanks, Federica, for that excellent overview of our paper. It's a lot packed in very efficiently. Olivier, do you want to come up and... you had some slides, right?
I had some slides, yes, indeed.
I'm not sure.
Should be downloaded.
Up.
Yeah.
And then where's the screen mode? Full screen mode there.
Oh, yes.
Okay. There you are. Okay, so they'll
come
up, yeah.
Okay, wonderful, great. No, thanks a lot. Okay, so it's a big task. Try to summarize, as you said, to try to summarize those papers. But at the same time, very excited and very happy to be here. Thanks for the invite, Dion. So I used to be in the Prosperity VP, dealing with climate and disaster risk, and recently moved to the Planet VP, dealing more with carbon markets, and kind of transition phase, and you'll see that. So I was at COP, and in fact, just maybe to share a couple of highlights from COP, and in fact, Federica, you did also mention some of them, which to some extent address some of the points you made in your research. One, on adaptation and resilience, a lot of focus on that, although we know that this is not something which is top priority, at least where the funding is going, and I will elaborate about that, and the launch of the fund for responding to loss and damage, this kind of new fund, agreed with the UN, and in fact, hosted by the bank. So I think it's a big highlight. And which also may change to some extent the architecture of the ecosystem around risk finance in particular, and adaptation finance more generally. The second takeaway from my side, which also echoed what Federica was explaining, is on the Article 6 carbon markets, and how to some extent to create some sort of a vibrant, at least working, carbon market to start, including with Article 6.2 and 6.4. It's all about the architecture and making the market, I would say, trusted by parties, and I think there is still a lot of work to be done. And the third one, which was also mentioned by Federica, is what we call the NCQG, the 300 billion being mobilized compared to 1.3 trillion that were, to some extent, asked by the country. So anyway, a lot of thinking around that. So when I was asked to comment on Federica's paper, and I was reading the papers carefully, I thought I have two options. Either I share with you some equations, or I share with you some visuals. since I'm not anymore good in equations, I decided to share some visuals and maybe to focus on one specific aspect, which is again was covered in Federica's paper, in particular the last one about the role of the banking sector when it comes to climate finance, and we'll see why it's important. And so my objective here is just to manage expectations, is not to share grandiose ideas, but just to share what we've observed and try to make the link and hopefully to some extent nourish some more future work you may want to think to explain what we are observing in this market. So first, visual, first slide, some of you may be familiar with this one. So it shows you to some extent how much is mobilized, but also how much is spent on mitigation and how much is spent on adaptation. And as we all know, there is a strong, I would say, focus on mitigation, much less on adaptation, which is about 16% of the total climate finance flows in developed economies when we exclude China. And out of that, 98% dedicated to adaptation finance in low-income and middle-income economies come from public finance. So definitely there is no private sector or private capital going to adaptation finance in middle and low-income countries. And then you can see how this is to some extent, I would say, how you can see by region as well. So this is one of the key points to address, and we know there is a big climate finance gap around that. So again, as I said, in my previous job, I was mainly looking at adaptation. Now I'm looking more from a kind of mitigation lens, but fundamentally, as you can see here, it's closely related, in fact, and there is a lot of conversation, in fact, now trying to see how we can, to some extent, leverage mitigation with adaptation and vice versa. And again, very happy to share a couple of examples later on if we have a few minutes. So in that context, what I decided to do is, as I said, to focus more specifically on the banking sector, which is de facto in most of the economies working in 80% of the total capital of financing comes from the domestic banking sector. It's something we can clearly not ignore. So we can definitely talk about sophisticated products, SLBs, and I'll have an example later on. But fundamentally, I don't think this is where the capital mobilization will come from. It will have to come from the banking sector itself. And then, of course, we can access capital markets. But in some of the economies, you start developing your banking sector, and then you move to more sophisticated solutions provided by the capital. Sorry. So Singapore will be here, and China will be here. Okay. Yeah, indeed. It's an advanced economy indeed. But good point, because this is something we can argue on. So this is from a recent study done by my former colleagues in FCI, looking at the climate finance in the banking sector. And some interesting results come from that. So first of all, on the left-hand side, this is more or less what Federica showed in her slide. What is interesting is on the right-hand side, where you can see that 5% or less of the lending portfolio of nearly 60% of the banking sector doesn't have any climate agenda. And then, of course, you have a small share of the banking sector, the banks being more involved in climate finance. But definitely there is a big gap, very little appetite. I wouldn't say interest, but at least appetite, and we can discuss why, for most of these kind of banks and the banking sector in general to invest in climate finance. So we can say whether it's not bankable, whether the regulation is not right. There are many reasons, and I'll let you, to some extent, address some of that, but fundamentally this is what we observe. And this is something we need to fix, again, if you want to mobilize or to channel more funding in those economies toward climate finance or green finance. The second message, which is related to that, and again, you talked a bit about that, is about it's about taxonomy. So we need for proper legal and regulatory framework, and it starts with the taxonomy. So again, interesting numbers here, where you can see that only 1/3 of the developing economies do have a kind of proper taxonomy compared to almost 100% in developed economies. So definitely, of course, more to be done in low and middle income countries. But at the same time, interestingly, there is no one approach, no universal approach. And taxonomies mean different things depending where you talk to, who you talk to, and where you work in this economy. So again, there is a lot of work to be done around that. a lot of work being done, in fact, by the bank and others trying to create some sort of, to harmonize, if I may say, this kind of classification for sustainable activities. So most of that are being done at the voluntary level. There are some attempts to make it a bit more mandatory. I think in Bangladesh, in China, in Colombia, Mexico, there is a trend to make it a bit more compulsory, but still, there's still a lot of work in progress. And again, you have to have it right in order to create the right incentives. But first, you need to have the right way to measure what you want to, at least to identify what you want to measure and classify what you want to measure. And the taxonomy is definitely the first step. Another interesting visual I would like to share with you is when it comes to climate risk supervision, and how countries react to that, and how the banking authorities in developed and developing economies are addressing that. So one interesting thing in our specific discussion here is about climate risk assessment. So it does cover both the kind of transition risks related to the mitigation risk most likely, and also the kind of more physical risk related to adaptation. But all in all, you can see that definitely it's much less advanced than in developing economies, and a lot of the authorities are working toward creating some sort of guiding principles, if not standards, in order to better capture, in fact, this impact of climate risks. So the Financial Stability Board or the NGFS are among these kind of international bodies trying to some extent to come up with some interesting discussions. I was in my previous job working with the NGFS, the network for central banks and the network for greening the financial sector systems, and again dealing with particularly with physical risks. And interestingly, just as a small anecdote, there was a lot of interest from developed economies to focus on mitigation, much less on adaptation, because of course most of these kind of large economies are not really impacted by big extreme events, while of course most of our clients are particularly interested, at least in the short term, with physical risks, extreme weather events. So again, sometimes you need to harmonize, at least you need to find a way to cover both interests from those different economies, because their interests, of course, can be sometimes a bit divergent. But all in all, there is a more awareness around taking into account climate risk when it comes to the supervision and regulation. But the question is, how are you going to measure that? What is the impact on the economy? Is it a systemic risk, or it's not a systemic risk? So a few years ago, back in 2021, in what we call the Financial Sector Assessment Program, one of the World Bank IMF programs, we looked at it, I think this was the first time we did it with the IMF, in the context of the Philippines, highly exposed to disasters, typhoons and earthquakes. Here we did focus on typhoons particularly, and we tried to measure the impact of physical risks, in that case typhoon, on the solvency risks for the banks. So in that case, it was quite innovative a few years ago, 4 years ago, and it was really trying to mix the kind of macroeconomic scenarios together with the climate models and together with the cat risk models and the macro financial models ultimately. So this was very much one of the first time we were trying to capture that in the kind of more traditional macro financial model. And frankly, the results were a bit disappointing. In other words, from a pure macro perspective, from a pure systemic perspective, even a major disaster in the Philippines will not have a systemic risk. It's not a systemic risk per se. If you combine that with some other risks, like in that case, a pandemic risk, yes, this kind of compounding impact may have a more significant impact on the solvency of the banks. But interestingly, when you just focus on these weather events, extreme events, the impact on the banking sector is limited. And there are many reasons for that. One is that usually those banks don't invest in areas where there is high risk. So in that case, of course, their portfolio is not very exposed. And the same can be seen in Africa, where we did the same analysis for droughts. And again, except the agricultural banks, most of the banks don't have an impact. I mean, the drought risk will not have an impact on their banking, on their portfolio, simply because they don't invest in those areas. They should, of course, in terms of development perspective, but simply they don't do because they're not forced to do it, or because the banks, because the investments are not I would say, attractive enough for them. So again, a lot of work has been done. This kind of, I would say, component is now being done as a module in the FSAP. So countries can, and we did recently in Indonesia, for example, can decide if it's a priority for them to look at the opportunities and the risks related to climate risks, including this kind of extreme weather events, and again see what will be the impact on the banking sector. And again, the same could be done on the insurance sector as well, but here it was mainly done on the banking sector. Last slide, last visual, just to again go back to the SLB agenda that Federica mentioned, just to highlight a kind of interesting deal that was done last year by my colleagues in long-term finance in FCI, in the Prosperity VP, where for the first time a development bank, in the case of Rwanda, did issue a sustainability-linked bond. So here is broadly how it works, but fundamentally there were three key I would say two key innovations, in fact. Three key innovations. One is it was done through the local capital market, so it was a local issuance by a local development bank. The second one was it was a sustainable linked bonds with some KPIs related in that case to, I just mentioned some of them, increasing the environmental, social, and governance compliance in the local financial sector. Another KPIs was about boosting the funding of women-led projects. And the third one was about financing a portfolio of 13,000 affordable housing projects. So these are the kind of KPIs which were used, very much aligned with the ESG and our development goals. And the third innovation here was, which is also quite important in that case, was to have this kind of credit enhancement. So for the country, in that case Rwanda, to use part of their IDA allocation to credit enhance their loan in order again to have lower interest rates. So it was done jointly with the World Bank Treasury. I think there was another issuance earlier this year. So again, this is a kind of model that could work again just to respond to what Federica was saying. We have some sophisticated countries. I think Uruguay is one of them. Chile also has done that. They're pretty sophisticated clients. But again, the same can be done with some adjustments in less advanced economies, like in the case of Rwanda. Okay, I'll stop here. I appreciate it was a bit disjoint, but just wanted to share those kind of thoughts, and hopefully this will help you shape your next and your future agenda. Thanks.
Thanks, Olivier, for ground truthing some of the things and pointing us in new directions. Before opening it up for Q&A, just any reactions, Federica, to some of what Olivier described? And just turn the mic on. You have to, yeah.
Okay, can you hear me? Yes, okay. No, this was a very interesting presentation. In fact, I was very happy that, I mean, we are more learning from you than the other way around, if anything. For sure, I mean, I was actually just thinking about the fact that there's clearly not all, I mean, I've always been talking about decarbonization goals, but clearly we have an even more pressing problem that there is no interest at all, seems, or appetite at all for climate adaptation investments. And so that's sort of like the first reaction that I had. And again, that the banking sector, the fact that the banking sector should be the first one to be not only regulated, but also informed about sort of like how to structure this lending and sort of also incentivize in these countries. And yeah, and then I wanted to know more in general about the issues that from the operational point of view, Olivier or his colleagues had when trying to indeed scale up and mobilize private capital throughout this innovative financing structure. And how I know that I was just talking to him in private, like some of these countries didn't manage to do it, and maybe what were the main challenges and what you see we could do going forward.
Thanks. Any questions in the room? I would ask, do you mind going to the mic? We'll come back to, if you don't mind, Olivier, we'll get back to it.
Does this work? Yeah.
Yep.
Hi, I'm Michel Noël. I'm consultant in FCI. I have I have, first of all, I would like to congratulate you for an excellent and very thoughtful paper.
Thank you.
Thank you so much. 2 points, one concerning the paper, one concerning the discussion. Concerning the paper, I think it would be good in future research maybe to consider the empirical evidence concerning sustainability-linked bonds. As you know, green bonds in general have a greenium of about 8 points. That's the best estimate that we see, sometimes less.
Yes.
But for sustainability-linked bonds, the greenium is about 1 basis point, which means de facto that there is no yield difference between a plain vanilla bond and a sustainability-linked bond. And in my view, there are 2 explanations for that. First, the quality of the climate transition plans that underlie the sustainability-linked bonds varied a lot. In a recent study in China, only 1 in 5 sustainability-linked bonds had a climate plan that was considered satisfactory by the Climate Bond Initiative. So which means that the market is extremely murky and not transparent. And the second point is that there are in those sustainability-linked bonds embedded options, which are very important because in many of these bonds, you can escape the trigger date. So if you see that you are not going to make it, you just simply exercise the option, buy back the bond, and you are not penalized. So at the end of the day, when you look at the real value added of sustainability bonds, you have to ask yourself the question whether it would not be better from a regulatory perspective to be very tough on the regulation of the underlying climate transition plans and let people finance them however they are, even through plain vanilla bonds. What matters is not whether your bond is plain vanilla or sustainability linked. What matters is the quality of the underlying transition plan. I think some research should be done there because, in my view, this is where regulations should go. And EU CSDR is one option that one can imagine. And the second point concerns your presentation, Olivier, and you will not be surprised by my remark. My advice would be actually to do this research on the impact of catastrophe on banks, but to do it also for bonds. Because as we all know, banks by their nature and by Basel III and IV are inherently restricted from taking risk, but because they need to protect depositors' money. So if you want to look at risk-taking, banks is probably one of the last things you want to look at. However, if you want to look at risk-taking, bonds is probably a market you want to look at. So without suggesting that we should not look at banks or regulate banks, my recommendation would be for future research to look also at the bond market, because you are likely to see much more significant reactions there, since they don't have to protect depositors' money at all. And you could extend that, of course, to private equity. Thank you.
Thank you.
Thank you. Just a reminder, if you have questions online, just raise your hand and I can call on you. And okay, let's go 1, 2, 3. Okay, thanks.
So sort of listening to both presentations, I was struck by sort of the difference between, I guess, direct and indirect effects here. So, you've got these, things that are trying, the Rwanda one where it's called sustainability, but then we're just packaging things that, giving credit to women or giving credit to the agricultural things. And, it's an indirect way at best of dealing with it. But then on the other hand, when we're doing these sort of risk assessments of banks, it seems like most of that is directly looking only at their direct exposure. Are you lending to areas that are going to be hit by this? But of course, if the whole country is hit by a typhoon, even if you are not lending to a firm that is directly wiped out, the economy's gone, people are not going to be shopping from other businesses. And so I don't know how this, direct versus indirect effects gets sort of captured in some of this work.
Thanks. Susie.
Thanks. Great presentation, Federica, to very intuitive explanation of the issues for people who are not familiar with this area. My question might be linked to the first comment. I wondered I was struck by how much all the results were predicated on preferences driving financing for green projects. And I wondered to what extent there are some straight economics of long-term economic gains from, say, the energy transition. So I recently came across this Econometrica paper. I won't remember the authors, but it gave the example of Chile investing in a transmission grid that linked a region in the country in the north where there was high potential for zero marginal cost renewable energy, and the transmission grid linked that area to the center, the capital area, where energy costs are very high, but economic activity is located there. And that building of that transmission grid resulted in entry of solar firms and created like orders of magnitude greater economic returns as a result of that entry. Now, that kind of a transmission grid wouldn't be financed necessarily by a green instrument, but results in sort of economic returns in general. So how does that kind of thing factor into this literature on green finance? Thanks.
Thanks. I'm Dilip Ratha. I'm actually now in MIGA and working with Federica as well on a green finance report. Richard Damania from Climate Change Group is leading a Livable Planet flagship report for the World Bank Group, and I have been charged with putting together that chapter on finance, green finance. So this is very, very timely, and I wanted to make one comment to the comments from Oliver. The EMDE banks that you have surveyed, are they emerging markets banks or EMDE country banks, or are they global banks? The financing is about the whole thing. So that's one clarificatory question. And on Federica's presentation and overall, how would we take into account sort of two distinguishing characteristics of green finance or climate finance? One is that this kind of financing probably has to be much longer term than the normal type of financing. And how would that interact or influence your results? So that is one characteristic, very long term. And the second characteristic is often the receivables generated by climate finance, climate finance instrument finance projects, they will be in local currency. So if you're talking about cross-border financing, it's a huge risk. And I haven't found that solution. It's a bit like searching for instruments and endogeneity, the search for nirvana in econometrics. I haven't figured out, I don't think I have seen anything on how to manage the local currency risk. So those are two characteristics. And the third factor, which is a very, very important factor for scalability, given the aspirations of how much we need and what we have in reality. We talk about structuring a lot. The moment you do structuring, the instrument becomes illiquid. So how do we manage that? So this is not directly relevant for your work right now, but it's very important for the report that we are going to come out in 2 months' time or something. Thank you.
Thank you all. We have one question online, and then I'll sort of go back to Federica and Olivier just to react to whichever comments. There's a lot of comments. So we have Carlos. Do you mind unmuting and just asking your question?
Yeah, absolutely. Thank you again this is Carlos. I'm with the IFC. Thank you for the great presentation. I have just one comment or one question for Federica. You showed heterogeneity in preferences, heterogeneity in intermediation, And I wanted to see if there is anything you know about heterogeneity in terms of the firms that have access to those instruments, right? I mean, you didn't show much of that other than assuming that the green technology was not as productive as the brown technology. The reason I ask that is because we're in the beginning of a project trying to understand the firm dynamics of sustainable finance and matching basically climate bonds initiative data and Bloomberg data to Orbis data to map which one are the firms that actually take advantage of those instruments. And given your knowledge of the literature, I just wanted to see if there's anything you know about that that can speed up our knowledge of that.
Thanks, Carlos. Well, given the number of people who say that they're asking a question because they're writing a report, this is definitely very timely. So back to you, Federica.
Okay, quite a lot of questions, and I didn't have notes as Oliver did, but I'll try to respond to everybody. So the first one was about the SLBs and the fact that they have a very low embedded green premium. That makes perfect sense. In part, it can be already explained by the model. I mean, I don't want to push the model, but in part, basically what I've been saying so far is that in presence of this manipulation, greenwashing risk, which can take various forms, such as, I don't know, as lack, transition plan, ability to opt out, etc. The firm can still have some sort of like advantage to issue that, and when we can discuss what's this disadvantage, but then the investor is not like stupid in some certain sense, is anticipating sort of like that there's a lot of greenwashing, and so the embedded amount of payment that is prepared to pay is actually very, very low. And so we have seen these bonds emerging because there's been some interest, some demand for it, but then still we need to go like a long way. And I think what you mentioned is probably like banking regulation, disclosure regulations, and sort of like a whole like regulatory structure that sort of like surrounds these issuances that would make them eventually more robust, would probably contribute to increasing the premium. And indeed, we see a better premium on green bonds because arguably we already have done quite a lot of work with the taxonomies. Also, the European Union has a pretty extensive taxonomy framework. And so I think, I mean, at least there is the sort of like the hope that these securities would get more sort of like implied financial reward once they get more regulated. Okay, so the other question was related. I think you're right. I mean, both the models sort of like start from the idea that it is not economically profitable for you to become green, and so you need some sort of like some investor or whatever entity that has some social outcomes that sort of like care about non-financial outcomes that would sort of like try to step in. But you're right that if this was economically beneficial, then you wouldn't need a dedicated market for it, right? You could just finance them with, I mean, at least theoretically, you could finance them with the conventional bonds, which also relates to the question that Carlos said. I mean, this is not my research, but I think it would be interesting to see. I mean, I think there's already a paper about, like a related paper about what are the firms that issue these securities. Sometimes the firms that issue these securities could have financed this investment with conventional bonds anyway. So those are like already regulated firms that have like already set up incentives to decarbonize. For them is already like financially profitable to do so. The investor already know that if they do so, it's going to have a financial return. And so probably they don't need to issue a green bond, yet we see that a lot of green bonds are issued by firms that already have the right incentives set up. And so maybe this is like a bottom, like a theory question, but also like an actual, for the operational side, I think it has something to do with like additionality. We do want that the firms that issue the green bonds are the one that sort of like need it the most. We had a project in Brazil that was especially sort of like targeted at doing so, sort of like trying to identify what firm would need this sort of like issuances, but then we had quite a bit of troubles in sort of like pushing this project, and so I would be very happy to see if there is something, some new project coming up and potentially also contributing to it. So that's one. But also, like to respond to Carlos, we see issuances of these securities also from some firms that actually need to issue these securities. Some like very heavy polluting firms, like from the material sectors, from so like emerging market economies. That, and I mean, at least like on paper, they could be sort of like the right ones that are accessing this market. Then, of course, as Dilip has said, there are like a variety of frictions that I'm not capturing that could prevent firms to access capital markets, especially in these economies. So the last questions were about the long term. Yes, I mean, basically my models don't take account of the huge dimension, which is risk. And this expresses in like currency risk, long term, sort of like the actually length of the financing structure. And so I think that's where, if I had to write a paper with the risk dimension to it, I would definitely write a paper for the role of development banks, because I think that the role of development banks is sort of like trying to manage to de-risk, right? And for example, I've seen that one challenge for the World Bank was to, maybe actually Olivier knows better, to try to make the issuance in local currency to sort of like make it like reduce sort of like the, so probably that's where the development banks should come in. And I think I'm done with my questions, and I'll leave it to Olivier.
You left me the tough ones. So one easy one on the banks in the survey. It's all bank licensed in the country. So it's all banks as licensed in the country. So maybe 3 points from my side. One on the greenwashing, I mentioned by Michel. I mean, it's all about the quality, the trust, and the transparency you have. And in fact, now working on the carbon market side and learning a lot from my colleagues, including from Klaus. It's all about your crediting methodology. It's all about what we call MRV, measurement, reporting, verification, that will to some extent create trust, and then will give a price to the quality of your product. And this is why you end up sometimes having carbon credits for $5 versus higher. It's because simply the market doesn't really appreciate, or doesn't really understand, or doesn't really trust, in fact, to some extent, the underlying assets. So a lot of work is being done around that. And in fact, in going back to Baku, there was an event organized together with our president, Ajay Banga, and Singapore about that. And Ajay Banga gave this kind of, and we're talking about trust and standard, and he said, why can't we create something like gold? We have to go 24 karat, 18 karat, 14 karat. So when I buy gold, I know what I buy. And I know that I'm going to pay more if I need to buy 24 karat versus 18 karat. So some extent coming with some basic standards will help to some extent create a market, and also create some goods that could be appreciated by the parties. The second point on, but also maybe Michel, the work we've been doing with FSAP, and this is why I did mention FSAP, this is very much from the solvency perspective. So I would say, to be a bit provocative, the only interest, particularly when we work with IMF, is from the solvency perspective, not from a development perspective. So in that context, you look at the portfolio of your banks, and you see whether a bank, when you stress test your bank, whether or not the portfolio will be impacted. If it's not, that's fine, nothing to be done. Why it's not? As I said, because sometimes those banks don't invest in those kind of risky markets, and maybe they should from a development perspective, not from a solvency perspective. So I do agree with you. If we were to be more specific on tracking the impact of climate risks, yes, looking at the bonds may be more relevant. But again, it was not the rationale for this kind of FSAP. Now, in terms of indirect and direct impact, definitely. And in fact, we did some work on the infrastructure side, building on what Stefan Algatz has been doing, and showing definitely that the direct impact on infrastructure is minimal compared to the indirect impact. It's about assets and services. It doesn't cost a lot to build, a tower for electricity. But of course, when you lack power, of course, this has a lot of indirect impact. So yeah, this has been calculated, but although it's quite complex, in fact, and we've been doing some work with Oxford University on that, if you're interested. And then the last point, yes, in terms of risk. In fact, this was one thing I was thinking when I was listening to Federica. This kind of risk dimension can be quite important indeed. And again, since I've done some work on that as well, it can definitely impact your ultimate results, depending on the type of risk you're going to face. But of course, then you can then introduce some product to de-risk that, including with insurance, the kind of guarantees, the work that MIGA is doing, and also, some other cat bonds when you move into some more sophisticated financial products. Thank you.
Thanks. We have a little time, so we have time for sort of one rapid fire round. We have one question online from Olivier, a different Olivier, presumably. Olivier, do you want to unmute yourself and ask your question?
Sure. This is Olivier. I'm an academic from Georgetown. Olivier, thank you so much for your insightful presentation, mostly on ESG, environmental, social, and governance crisis. And I would like just to come back on your trip to COP29. Do you think that this newly achieved fund from COP29, of course, can be highly invested in ESG globally? And secondly, do you have any other good example like Rwanda? I mean, with the framework that you have explained, which was very insightful to me. Do you have any other example like Rwanda, maybe in South Asia or MENA, which is Middle East and North Africa? Thank you.
So before turning back for final comments, anything else in the room? Nope. Okay, I think that one was mainly to you, but if you want to come afterwards.
No, the answer will be pretty simple. I mean, I think the case of Rwanda was the first of its kind. I'm not aware of any recent developments, although I should ask with my FCI colleagues. But this is again, this is the kind of model we would like to replicate more. Again, not only from the kind of I would say KPIs perspective, and we can also discuss, of course, the KPIs, but more on the kind of credit enhancing, again, to make access capital cheaper. So it's a nice also to leverage, in that case, limited IDA funding in order to access additional capital. So it's a nice way to mobilize private capital, which, as you know, and to blend, in fact, capital, which is quite important. So to answer your question, the model is there, has been tested at least once in the context of Rwanda, and to be tested in other countries. I know, for example, there is work as we speak in Kenya for the kind of same approach, I would say. Maybe not the same model, but at least the same approach.
Well, thank you to both of you for very insightful comments and great presentation and valuable discussion. I won't try to summarize everything, but just to say that it's been fascinating to me, somebody not in this space at all, just to hear the conversation, and I appreciate both the comments and the questions, because I think we had a really good discussion around some of these. I think there's food for thought and food for research, which is definitely something we want to have come out of these kinds of sessions. So thanks again to both of you, and thank you for being here. And thanks to those online. Thanks.
I'm Miriam Boone. We had a meeting for the Dublin. I just wanted to follow up. I mean,